Good morning, students, and welcome you all once again on today's topic on Ind AS 105 non-current assets held for sale and discontinued operations. So, students, today we are going to discuss one more asset-based standard. This is again an asset-related standard, right? So, where we will be talking about a non-current asset, right? So, what is a non-current asset? A non-current asset is an asset which is not a current asset, right? And what is a current asset? Current asset are those assets which will be realized, right, or which are going to be matured within 1 year, which is 12 months from the reporting date, or within operating cycle, right, or which are held for sale in the ordinary course of business. So what is meant by held for sale in the ordinary course of business? Like inventory. If Maruti is manufacturing cars, so cars for Maruti is an inventory, right? If DLF is selling properties, DLF is selling flats. So flats are inventory for DLF. Why? Because these flats are getting sold in the ordinary course of business. Right? But for example, Infosys is buying cars, or Infosys is buying, let's say, property from DLF. So for Infosys, these properties and these cars are property, plant and equipment or inventory. So of course, these cars, these flats, these properties are property, plant and equipment for Infosys. Why? Because these cars and properties are not to be used in the ordinary course of business for the selling purposes, right? But for DLF, selling properties is the ordinary course of business. For Maruti, selling cars is the ordinary course of business, right? So if something which is held for sale in the ordinary course of business, then it is known as an inventory and it will be covered under Ind AS 2. Okay. But if a non-current asset, what is a non-current asset? For example, property, plant and equipment under Ind AS 16, biological asset under Ind AS 41, which we have read yesterday, your intangible asset under Ind AS 38, investment property under Ind AS 40, right? So these assets are non-current asset by its nature, right? And if an entity wants to sell these assets, for example, there are 5 buildings which is belongs to Infosys. Infosys is having 5 buildings, right? And due to COVID, let's say if they are running into a cash crisis and they have decided to sell off one of the building, right? So when they have decided to sell off one of the building, so of course this building is a non-current asset, but when they have decided to sell this building, it will be converted into a non-current asset held for sale. Non-current asset held for sale. And the classification of this building will change from non-current to current. Why? So we will discuss later on what are the conditions for converting a non-current asset into a non-current asset held for sale, right? And why it is important to understand the condition, because the non-current assets by its nature, the non-current asset is a non-current asset which is used for the long-term purposes, which is used for more than operating cycle, which is used for more than 12 months. But non-current asset held for sale is something where the entity's intent is not to use the asset. The entity's intent is to sell the asset, right? And that is why the non-current asset held for sale has to be shown under the has to be shown under the bucket of current asset. Okay. So before starting my session, let me show you what the annual report, which will show you the classification of non-current asset held for sale. Okay. So let me know if my annual report of Ultratech Cement is visible. I believe the annual report of Ultratech Cement is visible. Is it visible, friends? Okay. Let's go to balance sheet. And in the balance sheet, you can see on the asset side, it starts with non-current asset, and there are a lot of non-current asset: PP, CWIP, right of use asset, goodwill, other intangible asset under development. These are the non-current assets, right? Then there are some more non-current assets. Then there is a total of non-current asset. Then there is another heading, which is current asset, right? Because in balance sheet, assets and liabilities has to be bifurcated into current and non-current. Okay. So if you see in current asset, there is an inventory. What is the difference between inventories and non-current asset held for sale? Let's take an example of Maruti again, right? Maruti Suzuki India Limited. They are manufacturing cars and they are selling cars. Okay. So these cars are inventory for Maruti. Why? Because these cars are for the purpose of sale in the ordinary course of business. Right? But Maruti Suzuki India Limited has 5 factories, or let's say have 5 buildings, right? So they want to sell one of the factory and they want to sell one of the building. So earlier, these factories, these buildings were shown under the non-current asset, property, plant and equipment. Under non-current asset, property, plant and equipment, right? But whenever they decided to sell and some conditions will met, I'm talking about some conditions. What are the some conditions we will be discussing later on, right? But if they've decided to sell and if some conditions are meeting for held for sale, in that case, those properties, those factory, those buildings has to be shown under current asset, but into a different category, into a different line item. And what is the different line item? The line item is non-current assets classified as held for sale. The non-current asset classified as held for sale. I believe you can see this balance sheet of Ultratech Cement Limited, which is a listed company, right? Which is a listed company. So inventory, what is the inventory for Ultratech Cement? The inventory is cements. Manufacturing and selling of cement is inventory. But what is non-current asset classified as held for sale? Let's go to note number 52. And when we will see the note number 52, let's see the note number 52. And we will found that it is not an inventory, it is something else, which is non-current in nature, but it is classified as held for sale and hence it become a current asset, right? Yes, you can see that the company has identified certain assets like land. See, land is never a current asset. Why land is shown here? Because it is non-current asset classified as held for sale. Okay. Aggregate mines, coal washery, right, which is available for sale in the present condition, right? So by nature, these assets are non-current asset, but since it is classified as held for sale and hence it has been shown under the current assets heading, right, as a separate line item. And that is why this standard is there. This standard talks about what is the treatment, what is the accounting treatment, what are the presentation requirement, what are the disclosure requirement when an asset, when an asset, when an asset will be classified as held for sale, and that is not in the ordinary course of business. Maruti's intent is not to sell the factory in the ordinary course of business. So Maruti is not in the trading of factories, right? Maruti is not in the trading of factories. Likewise, in the current example, real life example, Ultratech Cement is not in the trading of land. Ultratech Cement is not in the trading of coal washery. They are not in the trading of aggregated mines, right? They are having these mines, these assets for long-term purposes. But due to XYZ reasons, they have decided to sell off those items and hence these non-current assets are classified as held for sale. So friends, don't get confused with this line item, non-current asset classified as held for sale, with inventory. Inventory by its nature is held for sale in the ordinary course of business and it is always current, right? But under Ind AS 105, these are the assets which were classified as non-current by its nature, right? Like land. Land is a non-current asset. It is used for long-term purposes, right? But if entity has decided for sale, provided some conditions are satisfied, then it will be classified as a separate line item, non-current asset classified as held for sale under the current assets category, under the current assets category, right? I hope we are comfortable so far as introduction is concerned, right? Shall I move forward? Good. Yeah, so I can see a lot of response here. So Manini, Koshiki, Venkat Subramanyam, Rohit, Radhika. Good. So let me again go back to my PPT. Friends, in this particular standard, we will be talking about two things: non-current assets, and I'll call this non-current asset as NCA. NCA, non-current assets held for sale, right? So when I'm talking about non-current asset held for sale, I will be discussing about the accounting treatment, of non-current asset held for sale, right? Then presentation requirement and disclosure requirement. Presentation, disclosure. When I'm talking about accounting, I mean to say accounting includes recognition, measurement, everything, right? Recognition and measurement. Then presentation and disclosure. So non-current assets held for sale, right? So this standard talks about those assets which are already classified as non-current, but now classified as held for sale, right? PPE. PPE, it is covered under Ind AS 16, right? But if that particular PPE will be classified as held for sale, then it will cover under Ind AS 105. Understood? Intangible asset, it is already covered in Ind AS 38. But if, let's say, Infosys, TCS wants to, so software is inventory for Infosys and TCS. For example, Bharti Airtel wants to sell its license. They are not in the trading of license, but they want to sell telecom license, right? So if they want to sell telecom license, that intangible asset is a non-current asset. But when they want to sell this telecom license, so it will become non-current asset held for sale, right? And it will be shifted from Ind AS 38 to Ind AS 105. Clear? Understood? Right. So friends, we will be talking about non-current asset held for sale, and we will also be talking about discontinued operations. Discontinued operations, right? Discontinued operations. And I will use the short form of it, DCO. DCO, right? NCHFS DCO. As far as discontinued operation is concerned, so friends, what is discontinued operation? And in this particular standard, we will be talking about three things. One, non-current asset held for sale. And I'll start with the example. For example, I am having a factory in Lawrence Road. Okay. So if I'm having a factory, I am having a factory building. Okay. And inside the factory building, I have some machines, I have some furniture and fixture, I have office equipment, right? I have some raw material also. Okay. And there is a debt on this, and there is a debt on machineries, right? So I have taken machinery on loan. Okay. So let's say Manini came to me and she asked, sir, do you want to sell your factory? I told her, I only want to sell my factory building, right? Other than factory building, I want to keep everything and I want to shift these items to my new factory. Okay. So I only want to sell my factory building. So what is it? Is it a group of asset held for sale, or is it an individual asset held for sale? Is it a group of asset held for sale, or is it an individual asset held for sale? Tell me, what is it? What is it? Thank you, Saksham. Thanks for your feedback. It is an individual asset held for sale, right? Then Saksham came to me and said, sir, why don't you want to sell the entire factory? Since you are shifting to a new factory, why don't you purchase new machineries, new asset, right? So I want to buy this factory and please sell me this factory as a whole, right? So it means Saksham is asking that, sir, please sell factory building, machinery, furniture and fixture, equipment, raw material, right? Raw material, and whatever is there in the factory. It means Saksham is talking about group of assets. Am I right? And I have also decided to sell off this entire factory as a factory. Right. Earlier, I have decided to sell a building. Now I have decided to sell a factory, which includes a lot of assets. And these assets includes non-current as well as current. Okay. In a group of assets, Some assets could be current as well. Okay. But if there is an individual asset, it should always be non-current. But in group of assets, few assets could be current as well. Right. Friends, in this case, when I'm selling my entire factory to Saksham, is it a group of asset held for sale or is it an individual asset held for sale? Is it a group of asset held for sale or it is an individual asset held for sale? You're right, Manini. It is a group of asset held for sale, and this is known as a disposal group, right, friends? So in this standard, we will be talking about NCA HFS. We will be talking. Please write down, and I request all of you to please make a note of it. NCA HFS. We will be talking about individual asset held for sale. We will be talking about disposal group. The word is disposal group held for sale. DC, disposal group held for sale, right? DGHFS. Individual asset held for sale, disposal group held for sale, and third one. What is the third one? Discontinued operations. And this discontinued operation is much bigger, right? For example, Tata Steel is manufacturing, let's say, commercial vehicle as well as private vehicle. Let's say tomorrow Tata Steel wants to discontinue the commercial vehicle vertical, and they are selling off this entire commercial vehicle vertical, right? Friends, is it a individual asset held for sale? Answer is no. Is it a disposal group held for sale? Yes, it is a disposal group, but it is also a discontinued operations. They are discontinuing their operations, right? In my case, I was not discontinuing my operations. Why? I was shifting from an old factory to a new factory, right? I was not discontinuing my operation. But of course, there was a disposal group held for sale. But in this example, in this hypothetical example of Tata Steel, right? If they want to discontinue their commercial vehicle vertical, it is a discontinued operations, right? And discontinued operation includes disposal group held for sale. It may include, it may not include. We will be talking a lot about discontinued operation in the next class, right? So we will be covering this standard in 2 sessions, 2 class. One is today and one is day after tomorrow. Okay. So friends, as far as discontinued operation is concerned, the accounting part is taken care by disposal group held for sale, right? But this standard talks about the presentation and disclosure part of discontinued operations, right? Is it clear? Very good. So discontinued operation is like a cash generating unit. Discontinued operation is like a operating segment. Okay. Yeah. So friends, as far as standards are concerned, globally, it is IFRS 5. If you have selected a GFRS paper, which is elective paper, right? So globally, it is IFRS 5, which talks about non-current asset held for sale and discontinued operations. In Ind AS, we will be discussing about Ind AS 105, right? In our old accounting standard, when I'm talking about IGAP, there was AS 24, which was only talking about discontinuing operations. But as far as non-current asset held for sale, because this situation was always there, na? Many companies used to sell their non-current asset, right? So this situation was always there. But there was no separate standard under IGAP, which takes care of non-current asset held for sale. So there were 2 standards, AS10, which was related to fixed assets, right? AS10 talks about the tangible non-current asset held for sale. And there was AS26 relating to intangible asset, which was taking care about the intangible asset held for sale, right? So in IGAP, there were a combination of 3 standards, which was taking care of non-current asset held for sale and discontinued operation. And as far as specific and relevant guidance is concerned, there was very limited guidance in our IGAP, in our old accounting standards. But as far as Ind AS is concerned, we have a specialized standard, Ind AS 105, which takes care of such situations of non-current asset held for sale and discontinued operations, right? I believe in the last 15-20 minutes, the context, the agenda is clear to each one of you regarding this particular standard. Right? Clear? Good. So Manini, we will be discussing about discontinued operation. Don't worry. Okay. I have just given you the context that we are going to talk about 3 topics: individual asset held for sale, disposal group held for sale, and discontinued operation. Discontinued operation is much bigger than disposal group, right? And discontinued operation includes disposal group, right? So we will be talking about that thing separately. Okay. The objective of this Ind AS is to specify the accounting for asset held for sale and presentation and disclosure of discontinued operations, right? We talked about this. We have discussed about this in this slide. Okay. Scope part, the classification and presentation requirement of this Ind AS applies to all recognized, please mind this word, all recognized non-current assets and to all disposal groups of an entity, Friends, this standard does not tell you what is current, what is non-current. Who will tell you what is current and what is non-current? Who is the authority principle? Who is the authority standard for classifying current and non-current? Who is the authoritative standard for classifying current and non-current? Tell me. Ind AS 1. Ind AS 1 is the authoritative standard which classifies what is current, what is non-current in the balance sheet. Okay. Ind AS 1, presentation of financial statement. Para 66 talks about what is current, what is non-current. Right? When this standard comes into the picture? This standard comes into the picture when in the balance sheet there are recognized non-current assets, there are recognized current assets. But if the entity decided to sell a non-current asset or the entity decided to sell a disposal group, then only this standard will comes into the picture, right? But on the inception, at the time of initial recognition of non-current asset, this standard will not come into play. This standard will come into picture if there is a recognized non-current asset and entity has decided to sell those non-current asset, right? Good. So classification and presentation requirement of this Ind AS applies to all recognized non-current assets and to all disposal group. Please see, at the place of disposal group, the word non-current has not been used. Why? Tell me, for individual asset, the word is non-current asset held for sale. But for the disposal group, the word non-current has not been used. It is used as disposal group classified as held for sale. Tell me why. And I have already given you the answer. Yes, good, Radhika. So Radhika is saying, sir, because disposal group may include current asset as well. Very good. Please remember my factory example, which I have sold to Saksham. Right? It was including raw material also. Very good. And even though, friends, disposal group includes, even though the disposal group may include your liabilities as well. We will be discussing about that fact also. You are right, Koshiki. Sumit is saying, sir, in this Ind AS, current and non-current is always based on operating cycle, and this is not applicable for inventory. So, Sumit, I have a different view here. In this Ind AS, so this Ind AS does not talks about current, non-current, right? This Ind AS does not talks about operating cycle 12 months from the reporting date. This standard is silent. This standard says that if something which is recognized as a non-current, simple or current, whatever. So recognize as per what? Recognize as per Ind AS 1. If something which is recognized as a non-current, right, it will be classified as current in this standard if some condition held for sale condition will be meeting, which we are going to discuss later on. So this standard is not going to talk about, or this standard does not talks about any operating cycle, current, non-current, nothing. Ind AS 1 talks about the classification of item as a current and non-current depending on the 12 months period and operating cycle both. Right, Sumit? Clear, guys? Okay. So that's what which is written here. The classification and presentation requirement of this Ind AS 105 applies to all recognized non-current asset and to disposal group of the entity, provided some conditions will be meeting. Measurement requirement. Now coming to the measurement requirement, right? Measurement. If something which is classified as a non-current asset held for sale under Ind AS 105, then at what value it is going to be measured? So the measurement requirement of this Ind AS applies to all recognized non-current asset and disposal group except for scoped out assets. So friends, so far I haven't discussed the accounting treatment. I'm going to discuss, okay, after a few minutes. So this Ind AS 105 has some different recognition conditions. This Ind AS 105 has some different measurement conditions, right? So the measurement requirement of Ind AS 105 applies to all recognized non-current assets, applies to disposal group except some assets. And what are those assets? There are some negative lists, some exceptions. Deferred tax assets, right? If a company is reclassifying a normal asset means, for example, Ind AS 16 PPE asset to non-current asset classified as held for sale. And in this transaction, if there is a implication of deferred tax asset, the DTA has to be measured as per Ind AS 12, not as per Ind AS 105. If in the disposal group, there are some plan assets arising from employee benefit, you must have heard about plan asset, defined benefit obligation, right? So if there are some plan assets, those plan assets has to be measured as per Ind AS 19, not as per Ind AS 105. Okay. Financial assets. If there are financial assets, for example, when I'm selling a factory, I am also selling my debtors. So this is a financial asset. You will be reading this financial asset under Ind AS 109. Okay. So again, if there are some financial assets in the disposal group, so those financial assets will be measured as per Ind AS 109, not as per Ind AS 105. Okay. Non-current assets that are measured at fair value less cost to sell in accordance with Ind AS 41. Yesterday, we have discussed the concept of biological asset, right? And the measurement requirement of biological asset is fair value less cost to sell. So if the disposal group, for example, in my factory, there is a cow and I'm selling cow also. Okay. So that cow needs to be measured as per Ind AS 41, not as per Ind AS 105. Contractual rights under insurance contracts, right? So if there are some insurance contracts, so those insurance contracts are also going to be measured as per Ind AS 105. Sorry, as per Ind AS 104, not as per Ind AS 105, sir. But if there is an intangible asset, PPE, investment property, right? So if these assets are there, which is classified as held for sale, then which standards measurement requirement will be applicable? Friends, it is written now that the measurement requirement of this Ind AS applies to all recognized non-current assets and disposal group. It means for PPE, CWIP, investment property, right, intangible asset, the measurement requirement of Ind AS 105 will be applicable when these assets has been classified as non-current asset held for sale or disposal group held for sale. Right? Clear? Is it clear, friends? So friends, asset classified as non-current in accordance with Ind AS 1 shall not be reclassified as current asset, like land, building. So these are classified as non-current assets. Why? Because these are for long-term purposes. Sir, if it is held for sale in the ordinary course of business, like DLF, then of course it will be inventory, not a non-current asset. Okay. So if something which is classified as non-current in accordance with Ind AS 1, it shall not be reclassified as current until and unless they meet the criteria to be classified as held for sale as per this Ind AS. Until and unless they meet the criteria to be classified as held for sale as per this Ind AS. As per this Ind AS. Clear? Is it clear? Right? So friends, let me move to my Excel file, and please tell me if my Excel file is visible. Then I'll go to the accounting part of it. Is it visible? But before accounting part, I'll go to the recognition part, right? So recognition part, I mean to say the conditions of classifying an item as a held for sale, right? I hope it is clear to everyone so far. Yeah. First of all, what is NCA HFS? What is NCA HFS? And I request each one of you, please make a note of it. What is NCA HFS? Friends, what is the objective of, tell me, what is the objective of property, plant and equipment? The objective of property, plant and equipment is long-term purposes, right? The entity wants to avail the future economic benefit for long term, not for a short term, for a long term. And you must have read the definition of PPE. Even I have taken the session on PPE. So property, plant and equipment is tangible item which is held, which is held for use in the production and supply of goods and services, held for rental purposes, held for administrative purposes, and to be used for more than 1 year, right? More than one period, more than 1 year. Okay. It means the objective is long term. But the objective of NCHF is not long term. The objective of NCHF is short term. It means carrying amount. So under PP, the carrying amount is recovered mainly through use. But here the intent is the carrying amount is principally recovered through sale transaction, and not through the continuing use, right? What does it mean? It means if entity, so earlier the entity wants to use a building, right? That building was shown as a non-current asset under Ind AS 16 PP. And the objective from that building was to use that building for long-term purposes, either to run its office or to run its factory, right? But when the entity has decided to sell off that building, it means the future economic benefit of that building will come from the sale transaction, not through the use. So carrying amount is principally recovered through a sale transaction and not through a continuing use. So this is the definition of NCA HFS, right? In this standard, we are talking about three things. NCA HFS, which is non-current asset held for sale. I mean to say, we will be talking about individual asset held for sale. Then we will be talking about disposal group, DG. Individual asset held for sale. Then we will be talking about disposal group held for sale, right? What is disposal group? So disposal group held for sale means group of assets held for sale. Right? And this group of assets may include current asset as well. DZ may include current asset as well. Then we will be talking about discontinued operations, which is much bigger than, which is more impacting than disposal group operations, right? So we will be talking about these three things: NCHFS, disposal group held for sale, discontinued operations, right? Now the question arises, when a non-current asset, right, will be classified as held for sale, right? So it means, what is the classification criteria? Okay. So classification criteria. Now we need to discuss the classification criteria when an item will be classified as non-current asset held for sale, right? So there are two classification criteria, ISPC and HP, right? We will be talking about these two terms. Clear? So let me go back to my PPT. Friends, this non-current asset held for sale refers to individual asset or group of assets. An individual non-current asset is regarded as held for sale if its carrying amount will be recovered principally through a sale transaction rather than through continuing use. A disposal group is a group of assets to be disposed of together as a single transaction, right? Together with liabilities. If I have taken a loan on the building or a factory, on a building or on a machinery, and I'm also transferring the loan, it means I'm transferring the liabilities as well, right? Okay. So disposal group may include current assets and may include liabilities as well, right? That group includes goodwill acquired in business combination, and the group is CGU. And even in the disposal group, there could be goodwill also, right? If a disposal group is a cash generating unit, So you must have read, or you must remember AS 28, impairment of asset standard. Do you have some blur memory about this in the AS 28? Not in AS, AS 28, impairment of asset. And you must have read a concept of cash generating unit, right? So in the cash generating unit, the goodwill is also required to be allocated. Have you remember top down approach, bottom up approach in accounting standard AS 28, right? So if a goodwill is allocated on a cash generating unit, right? So goodwill, if there may be a goodwill which is allocated in a cash generating unit, so the disposal group may includes goodwill as well, right? So this is what it is. This is what which is written in the standard. So we'll be discussing, when we will be discussing the accounting treatment of disposal group, we will be talking about how this goodwill will be treated, right? Now we are discussing the heart of the standard. Heart, I mean to say, when a non-current asset will be classified as a held for sale. When a non-current asset will be classified as NCA HFS, right? So friends, for example, there is a building. For example, there is a building. This building is under Ind AS 16, and this is non-current asset, right? When the classification criteria, when the held for sale criteria has met, this building is still a building, but this building is now building held for sale, right? And from Ind AS 16, it will be shifted to Ind AS 105, and the nomenclature will be a non-current asset held for sale under the current asset category, under the current asset line item, which I have shown you with the help of Ultratech Cement balance sheet, right? Is it clear? Is it clear? Okay. So now we are discussing about the recognition criteria. I mean to say, when an item will be classified as held for sale, when a non-current asset will be classified as held for sale. So an entity will classify a non-current asset disposal group as held for sale if its carrying amount will be recovered principally through a sale transaction rather than through continuing use. Right? Asset or disposal group must be available for immediate sale in its present condition, and the sale must be highly probable. It cannot be classified as held for sale if the entity intends to sell it in a distant future. What does it mean? Friends, for classifying a normal asset, a non-current asset, into a non-current asset held for sale, two conditions will be meeting. What is the two condition? One is ISPC, please write down, and the second one is HP. If this ISPC plus HP will be meeting, then only you can say that non-current asset, a normal non-current asset, a normal factory, normal building, normal machinery will be classified as a NCA HFS or a disposal group held for sale under current asset, right? Under a current asset category. Sir, what is meant by ISPC? ISPC means Internet Service Provider Company. Please write down. Internet Service Provider Company. What is HP? HP means Hindustan Petroleum. But sir, is it the meaning of this ISPC and HP in the context of Ind AS 105? In the context of Ind AS 105. So this is the meaning, just to remember this ISPC and HP, right? But here it is not Internet Service Provider Company. Here it is immediate sale in present condition. Immediate sale in present condition. Please write down. Immediate sale in present condition. And HP is not Hindustan Petroleum. HP is highly probable. HP is highly probable. Now we will discuss one by one what is meant by ISPC. Standard says that an asset, a non-current asset, will be classified as a non-current asset held for sale if it is available for immediate sale in the present condition. If it is available for sale in the present condition. Available for sale in the present condition. Now I'll take an example to make you guys understand the meaning of ISPC, immediate sale in present condition. So I want to sell my building. Okay. So Koshiki came to me and she asked, sir, I have seen that you want to sell your building and you have also given some advertisement to sell this building, and you have also, put a for sale board on your building. So I told her, no, I don't want to sell it right away, because I am just thinking for putting a one more floor into the building, one more floor, then I will sell it. Tell me, is it available for immediate sale in the present condition? Is it available? It is available for sale, but is it available for immediate sale in present condition? I'm saying that no. I'm not want to. I want to sell, but I don't want to sell it right away. And I will sell. I will sell once my floor will be ready. Is it available for immediate sale in the present condition? Tell me yes or no. Tell me yes or no. No, you are right. No. Then Karthik came to me and he asked, he said, sir, if you will construct the floor, it will take a lot of time. You don't have time. Why not you sell this this building as it is? So I got convinced and I told him, okay, I want to sell this building, right? I don't want to construct the floor, and I want to sell this building right away in the same condition, right away in the same condition. Okay. So friends, in this case, when Karthik came to me and I have agreed to sell as it is, whether I can say that this is available for immediate sale in present condition? Answer is yes. Now it is available for immediate sale in present condition. I have not put in any condition that I will only sell when the construction gets over. There is no condition for making any construction, right? So friends, it is considered as available for immediate sale in present condition. It is considered as available for sale in present condition if intent and ability for sale will be there. And very good, Manini, you have mentioned that intention is not there in the first case, right? Have you got it? Have you got it? Yes or no? Okay. So friends, asset or disposal group will be classified as held for sale when two conditions will be meeting: internet service provider company and Hindustan Petroleum. What is internet service provider company? It is available for immediate sale in the present condition. Available for immediate sale in the present condition, and sale must be highly probable. Sale must be highly probable. Okay. It must be available for immediate sale in the present condition. Immediate sale in the present conditions. Okay. ISPC. Subject only to terms that are usual and customary for sales of such assets. So I agreed with Karthik that, okay, I want to sell this factory right away. But friends, can I sell it right away? Of course, there will be some time, na? There will be some amount of time which is usual time. For example, Karthik will give me a token money, right? Then there will be an agreement to sell. Then we will go to the registrar office, court, where the registry will happen, right? We'll get the time from the registrar. Okay. So this will have some time. Okay. This will consume some time. So it is a usual time. So available for immediate sale in the present condition does not mean that it has to be sold out just within a minute, within an hour, within a second. It does not mean that. It means that whether intent and ability is there to sell off this building right away. Yes, intent and ability is there. So if intent, for example, in my case, intent was not there, ability was there, but intent was not there, right? So you need to see whether intent and ability both are there. And of course, the time will be usual and customary. So whenever the customer will come, instantly I want to sell that asset, and the time will usual and customary for transferring the ownership, transferring the possession of that asset. It will be usual and customary. Okay, clear? Is it clear? Okay. So friends, what is meant by intent and ability? Intention, you all are clear, right? Like in the first case, when I was selling, when Kaushiki was asking for that building, my intent was not there to sell that building. Now, what about the ability? For example, I have purchased a plot of land, okay, and that plot and I want to sell this plot now. But this plot become a disputed one, and the court has granted a stay on that plot of land. So friends, I want to sell that plot, right? My intent is there, but whether I will be able to sell that plot till the time the court will not remove the stay on it? Answer is no. So what does it mean? It means intent is there, but ability is not there. So it will not be classified as held for sale. Why? Because intent and ability is missing. Intent is there, but ability is missing. It means it will not be considered as classified as held for. It will not be considered as available for immediate sale in present condition. So the first condition for qualifying to be classified as held for sale, the first condition is it must be available for immediate sale. The word is must. It must be available for immediate sale in present condition, right? And for checking whether it is available for immediate sale in present condition, the entity currently has the intention and ability to transfer the asset to a buyer in its present condition, right? So in this example, that intent is there, but the ability is not there. Intent is there, but the ability is not there. Okay, good. We have understood. So to qualify for classification as held for sale, it must be available for immediate sale in the present condition, subject only to the terms that are usual and customary for sale of such assets, right? For example, if I want to sell this building, I need to vacate the building, and the vacation time is normal, right? It will take 1 week, it will take 15 days, it will take 10 days, right? So that is okay. Clear? Now the second condition. Sale is highly probable. Sale is highly probable when management committed to a plan to sell the asset. Friends, so earlier we have discussed ISPC. Now we are discussing HP, Hindustan Petroleum. It is not Hindustan Petroleum, it is highly probable. Okay. Sale is considered as highly probable when. So before this, let me take you through some case study for available for immediate sale in the present condition. Okay. An entity is committed to a plan to sell a factory, right? The production cycle is 6 months and pollutants are involved. Pollutants are involved means the chimneys of the factory are emitting a huge level of carbon monoxide or pollution. Okay. Right? The production cycle is 6 months and pollutants are involved. So production cycle is 6 months means when the company is entering the raw material, it is taking a 6 months time to process that raw material. The company must meet its existing order, and it is written that whatever orders are there, the company has to meet the existing orders. It means, what does it mean? It means the company is committed to a plan to sell a factory. The company wants to sell the factory, but it will take 6 months at least. Why? Because for selling the factory, before selling the factory, the company has to meet its existing order, and for meeting the existing order, it will take 6 months at least. Then dismantling the equipment and cleaning up the pollution will put the facility out of action for another 6 months. So once they will complete the order, and then they will dismantle the equipment and clean up the pollution, will also take 6 months. So does the factory meet the criteria of available for immediate sale in the present condition? Tell me whether it is meeting the criteria for available for immediate sale in present condition. Yeah. In this case, tell me, no, not meeting the criteria for available for sale, available for immediate sale in present condition. Right, Manini? Why? Because the fact that several months must be spent fulfilling existing orders, 6 months, and then dismantling and cleaning the factory means that it is not available for immediate sale in present condition. I am not talking about whether it is sold out or not. I am talking about whether it is available for immediate sale in present condition, whether the entity's intention and ability is there. Intention is there, but ability is not there. Why? Because they have to meet its existing order. If they will not meet the existing order, probably the customer will sue this company. The customer will demand the penalty from this company, right? So ability is not there. I don't get confused by two different things. One, whether it is actually sold out or it is available for sale. We are talking about available for sale, right? We are talking, for example, this mobile. I want to sell this mobile. So whether it is available for immediate sale, it is available or not, it is important, right? For example, I have already purchased a new mobile, so it is available for immediate sale in the present condition, right? So if any buyer will come, I'll transfer the data, I'll format this mobile and hand it over to him. It will take around 2-3 hours. Okay, so that is a customary and usual time. Okay, but yes, it is available for immediate sale in the present condition. In the present condition, okay, doesn't matter whether it will be sold out or it will not be sold out. It is available for immediate sale in the present condition. It is available for immediate sale in the present condition. Clear? I hope it is clear to all of you. In this case, it is not available for immediate sale in the present condition. Why? Because first, they have to meet the orders. It will take 6 months. Second, for selling a factory, they have to dismantle the equipment, clean up the pollution. It will take another 6 months. Right. So for next 1 year, it is not available. I'm not talking about sale or not. I'm talking about available for sale. It is not available for sale. Right. I hope it is clear. Okay, good. Second, an entity is committed to a plan to sell its headquarters and has initiated action to find a buyer. Right? Situation number 1. The entity intends to transfer the building to a buyer. Intends to transfer the building to a buyer after it vacates the building. And the time to vacate is normal. Of course, the entity will transfer the building to a buyer only when it vacates the building. And the vacation time is normal, 5 days, 7 days, 10 days, 15 days, right? It is a normal time to vacate the house. Okay. Friends, tell me whether available for immediate sale criteria is meeting or not. Yes, it is meeting. Situation number 2. The entity will continue to use the building until a new head office is built. Until a new building is built. The building will not be transferred until construction is get completed. Is it available for immediate sale in present condition? Situation number 2. Is it available for immediate sale in present condition? Tell me, guys. Is it available for immediate sale in present condition? Rahul is saying situation number 1, yes. Situation number 2, no. You're right, Rahul. Rohan is also saying no. Situation number 2, no. Okay. Yeah. Yes. So in situation number 1, yes. Situation number 2, no. Okay. Why? Because there is a delay, and the delay demonstrated the building is not available for immediate sale in the present condition. Right? Clear? Second example. An entity is committed to plan to sell a factory. Manufacturing facility means factory. And has initiated action to locate a buyer. But there is a backlog of customer orders. There is a backlog of customer orders, right? The entity intends to sell the factory with its operations, and any uncompleted order will transfer to the buyer. Tell me, in the situation number 1, is it available for immediate sale in the present condition? Yeah. Is it available for immediate sale in the present condition? Why? So whatever is the present condition, it is available for sale. Why? Because it is saying that the entity wants to sell the factory with its entire operation, and whatever uncompleted order will be there, it will transfer to the buyer. Whatever uncompleted order will be there, it will be transferred to the buyer. It means the entity can sell the factory with the operations and orders as well. So it is available for immediate sale in the present condition. The condition will be met at the plan commitment date. Situation number 2, the entity wants to sell the factory but without its operation, and it does not want to transfer it until it eliminate the backlog of the orders. Second condition, second situation. It is saying that the entity wants to sell the factory but without its operation. Second, and it does not want to transfer the orders to the buyer, right? Buyer of the factory, and it wants to clear the order first, then only sell the factory. So tell me, in the situation number 2, whether it is available for immediate sale in the present condition. Whether it is available for immediate sale in the present condition. Tell me. It is not available for immediate sale in the present condition. It is not available for immediate sale in the present condition, right? Clear? It is not available for immediate sale in the present condition. Is it clear, guys? Is it clear? Okay. Now let's discuss the HP. Now let's discuss the HP. So friends, for considering a normal asset, I mean to say a non-current asset or disposal group as a classified as held for sale under Ind AS 105, if two conditions will be meeting. First, available for immediate sale in present condition. In PC is very important. Available for immediate sale in present condition, and sale is highly probable. What is meant by highly probable? Sale will be considered as highly probable when 5 conditions will be meeting. What are those 5 conditions? First, management committed to a plan to sell the asset, right? And as an article, as a chartered accountant, as an auditor, how you will ensure that yes, management is committed to a plan to sell the asset. Whenever friends, management is selling a disposal group, or management is selling or planning to sell these non-current asset, there must be a board resolution for that, right? So they are discussing it in the board meeting, and they are discussing this in the board meeting, and they are also passing the resolution for selling the disposal group, the non-current asset, the discontinued operations, right? So friends, management must be committed to a plan to sell the asset, and for this you can see the board resolution, board minutes, right? Active program to locate a buyer has been initiated. For example, if a company wants to sell its factory and they have already started inviting quotations, inquiries, they have listed this in 99 acres, right? Prop Tiger. They have also put the advertisement on their websites, right? They have started talking to others that yes, we want to, this factory is available for sale, and they put the for sale board outside the vicinity of the factory and at the gate of the factory, right? So the active program to locate a buyer has been initiated. The first one is committed to a plan, and active program to locate a buyer has been initiated. For example, sir, how we will ensure that yes, active program has been initiated, started? So you need to inquire, you need to ask the management how, you need to ask the management what efforts you have taken to locate a buyer, right? Show me. Have you, so then management will show you that yes, we have given an advertisement in the local newspaper, right? We have listed this on our website. We have started talking to our competitors, right? So you need to look at those aspects, okay? So management must be committed to a plan to sell the asset. Active program to locate a buyer has been initiated. Actively marketed for sale at a price which is reasonable in relation to its fair value. And the price is also reasonable. Reasonable means the price is also reasonable with respect to market value. For example, the factory which is available for sale, so the market price is roughly 2 crore rupees, and the management wants 3 crore rupees, 4 crore rupees. Can you say that it is actively marketed at a reasonable price? Answer is no. But yes, the market price is 2 crore rupees and management has quoted, let's say 2.25 crores. So that is considered as a reasonable. Why? Because if somebody will come, of course he will negotiate also. So that is okay, right? So you need to see that what is the market price, right? So what are the valuation report, right? And what the price management is quoting and management is demanding for that factory, right? Understood? Any challenge so far? Yeah. Point number 4. Sale should be expected. Please see, the word is expected. Sale should be expected to qualify for recognition as a completed sale within 1 year from the date of classification. Within 1 year from the date of classification. Sale should be expected to qualify for recognition as a complete sale within 1 year from the date of classification. From the date of classification means the date on which the asset has been classified as non-current asset held for sale. It is not always on the reporting date. It could be on the different date also. For example, today is 20th November, and today I am having a building and I have decided to sell it right now. Right now means in the present condition, I want to sell it immediately. If somebody will come, I am okay to sell it. Okay. So that is one criteria. That is one part. ISPC is one part. Okay. ISPC only gives you answer of whether it is available for immediate sale. Yes, it is available. Yes, it is available. Understood? भाई बेचने के लिए available है क्या? हाँ है. Okay. Then HP gives you another part. So ISPC shows the intent and ability. HP shows the efforts. Okay. And what is HP? HP says that now the second question is in terms of a company, whether the management is committed. Of course, you need to look at the board resolutions, minutes, right? Yes, management is committed. Have you started searching buyer? Yes, we have started searching buyer. Have you quoted a price which is a reasonable price? Yes, we have quoted a reasonable price. Okay, understood, right? And whether sale is expected to qualify for recognition as a complete sale within 1 year. So will you be able to sell by 20th December? Will you be able to sell by 20th November 2022, 23? Okay. So today we have classified this asset as an held for sale. So will be completed within 1 year from today? Answer is yes. Subject to event outside entities control. It is also written that subject to events outside entities control, right? Everything was there. In between COVID came and there was a lockdown for 5 months. So this is an exceptional criteria. This is an exception, right? If due to the events outside entities control, the sale has not been completed even within 1 year, it is still continue to show as a held for sale, right? So there is a 1 year rule. What is a 1 year rule? It is expected that sale will happen at least within 1 year from the date of classification as held for sale, right? And the fifth condition is the actions required to complete the plan indicate that it is unlikely that the plan will significantly change or withdraw. The management has reached at such an advanced stage. The management has reached at such an advanced stage that it is unlikely that the plan will change or plan will withdraw. Right? It is unlikely that the plan will change or plan will withdraw. For example, the management has already started shifting to a new factory. The management has already started dismantling the machinery of the old factory and already started shifting the machinery to the new factory. The workers has already the locations, the residence of the workers has already transferred nearby the new factory. It means the management has reached at such an advanced level that it is unlikely that the plan of sale will change, right? So sale has not happened right now. Sale has not happened. It is available for immediate sale in the present condition. Management is committed. Active program to search a buyer has been initiated. Price is reasonable. And management is expecting that, yes, if we will be able to sell within 1 year, right? If some unexceptional circumstances will happen, then we can't say anything. But yes, in normal scenario, we are hopeful. We are highly hopeful that we will be able to sell within 1 year, right? And the actions of the management also shows that the management, so in future, the management don't want to change its plan and management will be stick to their plan for sell the asset, right? Is it clear, friends? Clear? Okay. So friends, these 5 conditions should be satisfied for classifying a non-current asset as held for sale, And before moving into that, again, let me show you the Ultratech Cement balance sheet once again. Okay. And this time I'll go to the accounting policy of Ultratech Cement and note number 52 as well, right? So that you will have a more perspective on this. Yeah. Please see non-current assets held for sale, non-current asset or disposal groups classified as held for sale, right? So I'll read this accounting policy and you will surprised to see that whatever I taught you, whatever I have shared with you so far, you will find that stuff in the listed companies annual report accounting policy. The company classifies non-current asset as held for sale if their carrying amounts will be recovered principally through a sale transaction rather than through a continuing use. Have I told you this line? Have I told you this line that the non-current asset as held for sale, the company should classify the non-current asset as held for sale if the carrying amount is principally intended to be recovered through a sale transaction, not through a continuing use? Yeah. So Manini, in case of change of plan, yes, change of plan can happen, right? We will talk about that. So there is a different accounting treatment and we will cover that aspect. Okay. And this subject to event outside and this I have already discussed, right? They have copy pasted. Koshiki is saying they have copy pasted. Yeah, because this Ind AS is applicable to all the listed companies, right? This condition is regarded as met only when the asset is available for immediate sale in the present condition. Oh, sir, you have also said this few minutes ago. When the asset is available for immediate sale in its present condition, subject only to terms that are usual and customary for sales of such asset, and the sale is highly probable. Sale is highly probable. And the sale is highly probable. Have I told you this aspect also? That it is available for immediate sale in the present condition, subject only to the terms that are usual and customary for sale of such asset, and the sale is highly probable. Guys, I'm just showing you how these listed companies are also working, right? Good, good. Okay. Now I'll show you the note number 52. And they have written that such asset or group of asset classified or liabilities are presented separately in the balance sheet in the line asset or disposal group held for sale, right? So they have written that. Okay. So now let me show you the note number 52 as well. Now read note number 52 once again. Read note number 52. The company has identified certain assets like land, aggregated mines, coal washery, etc., which are available for sale in its present condition. Available for sale in its present condition. The company is committed to plan the sale of asset. Sale is highly probable. The company is committed to plan the sale of asset and an active program to locate a buyer and complete the plan has been initiated. The company expects to dispose of these assets in the due course. In the due course means even less than 1 year. Friends, this is the listed companies annual report, Ultratech Cement, Nifty 50 companies. Right. And I'm showing you from the latest annual report, last to last year. Right. And whatever I have taught you theoretically with my layman language examples, I'm showing you practically in the listed companies annual report. One of the largest listed companies annual report. Right. Clear? Great. Good. Thank you, Radhika. I'm really glad to have such kind of feedback. Thank you so much. Yeah. So now let's come back to the PPT once again. So we have discussed these aspects. Okay. Now let's discuss this example number 6 from the Institute study material. Although these examples were also there in Institute study material, this I have already shared with you. At the end of the reporting period, ABC Company's board of directors has approved a plan to sell a non-current asset. At the end of the reporting period, okay. The eventual disposal requires approval by a majority of company's shareholders through a formal vote, which will take place after the reporting period. Okay. So friends, the board has approved a plan to sell. Okay. But the actual disposal will require approval of the company's shareholder through a formal vote, right? Which will take place after the reporting period. At the end of the reporting period, a majority of the company's shareholder have provided the company with signed irrevocable agreement stating that they will vote in the favor of the disposal. So friends, at the end of the reporting date, the board has approved, but the actual disposal will require a shareholder approval, majority of the shareholder approval, right? And this shareholder approval will happen after the reporting date. Okay. But at the end of the reporting date, the majority of the shareholders have given the consent with irrevocable, signed irrevocable agreement, which is not revocable, right? That they will vote in the favor of the disposal. So friends, in this case, the highly probable test is met. Why? Because the shareholder have irrevocably committed to approving the transaction, and therefore the vote by the shareholder is merely a formality, right? So on the reporting date, now the question comes, on the reporting date, will you classify this asset as a non-current asset held for sale? Answer is yes. Why? Because the management is committed to a plan to sell the asset. How come it is possible? Because of course it is depending on the majority of the shareholder approval, which will happen after the reporting date. But these shareholders have already given their consent that they will vote in the favor of this decision, right? So that is only a formality, right? And hence these asset will be classified as a non-current asset held for sale, as the highly probable test is meeting in terms of management is committed to sell the asset, right? Clear? Is it clear or not clear? Yeah. Good. Aniket is saying crystal clear, sir. Very good. Perfect, sir. So in your highly probable test, you have said that sale should be expected to qualify as a complete sale. Sale should be completed within 1 year. Expected to be completed. Subject to event outside entities control. Subject to events outside entities control. Okay. Now the question comes, what is the exception to 1 year rule? Sir, what is the exception? When an asset will be still classified as highly probable, sale is highly probable, even though it is beyond 1 year. So standard has given you 2 exceptions. What are those exceptions? An extension to the period to complete sale may extend beyond 1 year due to circumstances outside the entity's control. An extension of the period to complete sale may extend beyond 1 year. It may extend beyond 1 year due to circumstances outside the entity's control, which is due to the situation outside the entity's control. Can you give me an example of situation outside the entity control? Can you give me the example? Can you give me an example of that? COVID. Whether COVID is within the entity's control. COVID is outside the entity's control. Second example. 3 years back, I have purchased a flat in Faridabad. Okay. So I have already given a token money. I have paid 50% advance. I have then paid another 50% money, right? When the seller and let's say myself has decided to get it registered, right, has decided to get the registry in my name, in my favor, in Faridabad, the court has, stopped the new registration of the properties. The court has stopped, and it was stopped for around 8-9 months. Okay, around 12 months or 8-9 months, right? So the regulators, the courts, the judiciary have stopped the new registration of the properties, right? So whether it is within the control of the seller, answer is no. But I have already paid the money and seller still wants to sell this property, and he told me that if you want to take the position, you can take the position, and whenever the court will open, I will be happy to transfer the ownership in your name, right? And again, a very good example given by Manini, strike of creditor or trade union is again one of the example, right? For example, a company wants to sell the factory, but there is a trade union strike, right? And the company is negotiating with these parties, right? So this is something which is outside the entity's control. So friends, even when it go beyond 1 year, it will still be classified as sale is highly probable if two conditions are meeting. What are those two conditions? The two conditions are: one, it should be beyond entity's control. Second, there must be a firm purchase commitment. There must be a firm purchase commitment. What is meant by firm purchase commitment? The firm purchase commitment means there must be a agreement. There must be a binding agreement. Firm purchase commitment, please write down. Firm purchase commitment means binding agreement. Binding agreement, right? If any party will withdraw or any party wants to walk away from the contract, wants to breach the contract, that party has to pay the severe penalties. So in my case, there was a firm commitment, and even I paid the money as well, right? I paid the money as well. So there was a firm purchase commitment. There was a agreement. There was a contract, binding contract, right? Like this seller has to sell me the property. I have the complete right to enjoy the possession of that property, ownership of that property, right? So, and seller is entitled to get the entire money for that property. So first, there must be a binding agreement. Second, the circumstances should be beyond entity's control. So unexpected condition imposed by the buyer or third party after the firm purchase commitment is obtained, right? So friends, there is a binding agreement and the seller has entered into a contract with the buyer, and buyer has also entered into a contract with the seller, right? And after this contract, the buyer has imposed some condition, right? For example, the seller and buyer has entered into a contract for the purchase of the factory. But when the buyer has visited the factory, he has told the seller, already contract is there. He has told the seller that please, before selling this factory to me, I want you to clean up this entire chimneys, right? Because I've seen that these chimneys are emitting a lot of pollutions, right? And probably when you will sell me and when I'll start running this factory, if the pollution department will come, so I will be liable to pay severe penalties. So I want you to clean up this entire pollution, clean up these entire pollutants, clean up these chimneys. Okay. So the buyer has, imposed some conditions on the seller after this binding agreement. So it will take some time, right? So friends, if there is a binding agreement and the buyer or third party has imposed some condition, which will take this 1 year window to beyond 1 year, still it will be classified as sale is highly probable. Second, the unexpected circumstances delayed the sale or disposal of asset or disposal group held for sale. Of course, this unexpected circumstances like COVID, trade union strike, right, creditor strike, okay, or this non-registration, right, or buyer condition has already delayed the sale. Delayed the sale means delayed the complete sale. Okay. In such circumstances, asset or disposal group will be still classified as held for sale, right? It will be still classified as held for sale. Friends, Kejri Vidyut Limited, an energy sector company, is committed to selling one of its business lines, right? This requires regulatory approval. It could take more than 12 months to obtain this approval, right? So this company wants to sell one of the business line, which will require a regulatory approval, and it could take it is not always taking more than 12 months, but it may take, right? However, a firm purchase commitment must have been signed before approval can be obtained. So the company will apply for approval only when there is a binding agreement. And there is a binding agreement, right? And approval may come within 12 months, or it may take more than 12 months, right? Which is outside the entity's control, this regulatory approval. In the present case, sale is highly probable within a year, right? So in this case, sale is highly probable within a year. It could take more than 1 year, right? In this situation, the condition for an exception to the 1 year limit would apply. As the sale is highly probable, it may be classified as held for sale, even though it extends beyond 1 year. Even though due to the approval, it extends beyond 1 year, right? Sir, if regulators will not provide the approval, then what will happen? Friends, first of all, when you are deciding whether sale is highly probable or not, you have to look at the past precedents as well. Is it a normal scenario for getting the approval from the regulator? Although it is a time consuming process, but is it a normal scenario? Answer is yes. Then of course you will consider this sale is highly probable. But even though if regulator will deny, in that case, at the time of denial, this asset will classified again. This asset will reclassified again as a normal asset. This asset will be reclassified from held for sale to a normal asset in this scenario. But normally it does not happen like this. Okay. So the concept is if there is a binding agreement and there is a delay due to the circumstances outside the entity's control, or due to the delay is there due to the buyer's condition or a third party condition, in that case there is an exception to 1 year rule, and even though it is extending beyond 1 year, it will still be classified as sale is highly probable, right? Clear? Is it clear? Manini is asking, sir, who will bear the loss or consequences of this condition? Who will bear, right? For example, if it is due to the buyer's condition, so buyer will bear the loss, right? For example, it is like tsunami, or it is like let's say what would I say, COVID, right? Earthquake, then of course seller will bear the loss, right? Is it clear? Okay, yeah, I hope it is clear to all of you. Next example, an entity is committed to sell a manufacturing facility, but after a firm purchase commitment is obtained, the buyer's inspection identify environmental damage that must be made good, and this will extend beyond 1 year. So an entity is committed to sell a factory, but after the binding agreement is entered, the buyer's inspection identify the environmental damage which must be made good, and this will extend beyond 1 year. However, the entity has initiated appropriate procedures to repair the environmental damage, and the sale remains highly probable. However, the entity has initiated appropriate procedures, right? The entity has already started to repair the environmental damage, to repair the chimneys so that they will not emit this carbon monoxide or pollution, and the sale remains highly probable, right? If the sale is highly probable, it can be classified as held for sale. Clear? Is it clear, guys? So this example I have already discussed. This I have already discussed in my last slides, right? Okay. Is it clear to all of you, friends? I hope it is clear to all of you. Now let's go back to my Excel file once again. and where I was sharing you the notes. So coming to the classification criteria, my dear friends, we have discussed that the classification criteria is ISPC plus HP. What is meant by ISPC? ISPC means it is available for immediate sale in present condition. Available for immediate sale in present condition, right? This condition shows the availability for sale, which is depending on the intent and ability, right? HP sale is highly probable, right? Sale is highly probable, and this condition shows the efforts and documentation regarding the effort towards the actual sale, right? And what are these conditions? Sale is highly probable. What are those conditions? Committed to a plan to sell, right? Second condition. What is the second condition? Searching buyer initiated. Third condition, reasonable price. Quoted. Fourth condition, likely complete the sale within 1 year. Fifth condition, unlikely that plan of sale will change, right? So these 5 conditions we have discussed. And what is the exception to 1 year rule? What is the exception to 1 year rule? What is the exception to 1 year rule? So this is, what is the exception to 1 year rule? So due to circumstances beyond entity's control and plus firm purchase commitment. What is meant by firm purchase commitment? Firm purchase commitment is binding contract. Binding contract has been entered, right? Binding contract has been entered. Clear? I hope so far every one of you is clear, right? So Manini is saying, sir, if due to natural calamities like let's say tsunami or let's say COVID, who will bear? So Manini, in this case, the property in whose possession? The property is in the possession of the seller. So normally seller will bear, but of course in this kind of scenario, it is kind of a mutual understanding, right? So it could, for example, when this COVID came, so a lot of landlord has waived the rental, right? So going by the contract, the lessee has to pay the rent to the lessor, right? But they have, in this kind of situation, they have again discussed, negotiated, and come out at a bridge, right? Whether nobody will be pressurized. Okay, this is more of a discussion and negotiation which will happen. Okay, good. So I hope I have given you so many examples, right? So many examples. I have shown you so many case studies, and I have also make a note on the Excel file as well. And I hope you guys are comfortable now, right? So friends, it's 8:30 now. Let's have a 10 minutes break and we will start after break. Okay. So we'll start at 8:40. continue this topic, and let's discuss the one new concept of abandoned asset. What is meant by abandoned asset? For example, there is a company and the company was having 4 machineries, right? And let's say machine number 1, 2, 3, and 4. These 4 machineries are there, okay? And this is M1, M2, M3, M4, and this company is into, let's say, woolen manufacturing of woolen clothes, right? In summers, normally the demand got declined, right? But of course, they're manufacturing just to have a good stock at the time of winters, right? So in summers, normally what they do, normally they pack these 2 machines, machine number 3 and machine number 4. They pack these machines and they start using this machine when the demand will pick up, right? So since the demand is not there, so they are just using these 2 machines and they are packing and shifting these machines to the godown, or let's say the machines are there only, but they are not using these machines, right? So these kind of asset are known as an abandoned asset. Now the question arises whether abandoned asset can be classified as held for sale. Can the abandoned asset be classified as held for sale? Answer is no. Why? It is not meeting even the first condition of ISPC. It is not available for immediate sale in the present condition. Rather, it is not available for sale. It is not available for sale. The entity's intent is not to sell these assets. The entity's intent is to use this asset when the demand will pick up, right? Friends, if in the question, in the examination, if it is given that the asset is taken temporary out of use and it will be used when the demand will pick up, and the company does not foresee that the demand will pick up in the next 1 year or in the next 9 months, right? So don't get confused with that. This is not a held for sale asset. This is an abandoned asset. And just apply your mind that for converting any asset as a held for sale, your 2 conditions will be meeting. One is ISPC, and of course, since it is an abandoned asset, it is not meeting the condition of available for sale, right? The condition is available for immediate sale in present condition, and even though it is not meeting the condition for sale as well, right? So a non-current asset or a disposal group which is to be abandoned, should not be classified as held for sale. For example, a factory is abandoned. There are 3 factories. The company has stopped production in 1 factory, right? And the company is continuing with 2 factory only. So that is abandoned factory, abandoned disposal group, right? But it is not classified as held for sale. This includes non-current assets that are to be used to the end of their economic life. The intent is to use, and non-current assets that are to be closed rather than sold, right? Because its carrying amount will be recovered principally through continuing use, not through a sale. Clear? Entity, example number 13 from Institute Study Material. Entity ceases to use a manufacturing plant because the demand has declined. However, the plant is maintained in a workable condition and it is expected to be brought back into use in future when the demand will pick up, right? It is neither to be treated as abandoned asset nor as held for sale because its carrying amount will be principally recovered through continuing use. Therefore, the entity will not stop charging depreciation or treat it as held for sale. This is because its carrying amount will be recovered principally through continuing use to the end of its economic life. It is not written correct here. It is neither to be treated as abandoned asset. So basically, it is to be treated as abandoned asset, right? Not as a held for sale, right? It is an abandoned asset. It is an abandoned asset. Okay. Clear? There is no separate, no Rohan, there is no separate disclosure for abandoned asset. Okay. This is just a concept which is given in the standard so that the user will not get confused. The preparer of the financial statement will not get confused that something which is not something which is not in use should not be considered as held for sale, right? Clear? Clear? Okay. Yeah. So let's now discuss about the measurement criteria, measurement part, right? What is a measurement criteria? And let me go to my Excel file, and now we will be discussing the measurement provisions of Ind AS 105. Measurement provisions of Ind AS 105. Right? What is the measurement provision of Ind AS 105? First of all, step number one. Calculate carrying value of non-current asset held for sale on the date of classification as non-current asset held for sale. The first step, calculate the carrying value. Calculate the carrying value of non-current asset held for sale. Calculate the carrying value of non-current asset held for sale or disposal group. Calculate the carrying value of NCHF or disposal group on the date of held for sale. On the date of held for sale. On the date of classification. On the date of classification is held for sale. On the date of classification is held for sale. Step number two. Compute or calculate the fair value less cost to sell. Calculate the fair value less cost to sell. Calculate the fair value less cost to sell on the date of classification as held for sale. Right? Step number three. What is step number three? Recognize non-current asset held for sale. I hope my Excel file is visible to all of you. I hope it is visible to all of you. We are discussing measurement aspect. Okay. So third step, recognize NCA-HFS. Recognize NCA-HFS or disposal group at lower of carrying value under step number one and fair value less cost to sell under step number two. Right. So these are the three measurement provisions of Ind AS 105. First, you need to calculate the carrying value of NCHFS or disposal group on the date of classification, right? So before entering into the room of Ind AS 105, we need to calculate the carrying value as per the respective standard. For example, if there was a building which is classified as held for sale on 1st of October, so you need to compute the carrying value of that building as per Ind AS 16 on 30th of September, right? Calculate the carrying value of NCA, HFS or DG on the date of classification as HFS as per the respective standard. Example, Ind AS 16, 38, 40, etc. Okay, understood? Then calculate the fair value less cost to sell on the date of classification as HFS as per Ind AS 105. And then it says that you need to recognize NCHFS at lower of step number one and step number two. Okay, so don't worry. Let me discuss one case study here. Example: A Limited purchased a building for rupees 20 lakh on 1st April 2019. Right. So the cost of the building is 20 lakhs. What is the cost of the building? 20 lakhs. Solution. Cost of the building is 20 lakhs. Okay. The useful life of the building is 10 years. What is the useful life? Useful life is life is 10 years. The useful life is 10 years. Okay. Assume no residual value. The residual value is 0. The building has been, and what is the per annum depreciation? What is the per annum depreciation in this case? If the cost is 20 lakhs, useful life is 10 years, no residual value, then it is 2 lakhs per annum. 2 lakhs per annum. Right. The building has been classified as held for sale on 1st July 2020. The building has been classified as held for sale on 1st July 2020. So what is the date of classification as HFS? Date of classification as HFS is 1st July 2020. You are required to show how the necessary entries. You are required to show the necessary entries for this effect. The fair value less cost to sell on 1st July 2020 is 16 lakhs, and the fair value less cost to sell on 1st July 2020 is given, which is 16 lakhs. Friends, this information is given, this simple information is given. Now let's go step by step. Let's go step by step. Step number 1. What is the step number 1? Calculate the carrying value. Calculate the carrying value. Calculate the carrying value of building. At which date? As on which date? It was classified as HFS on 1st July. So we need to compute on 30th June. Calculate the carrying value of building as on 30th June 2020 as per Ind AS 16. And what is the definition of carrying value? What is the definition of carrying value? What is the definition of carrying value? Carrying value definition is carrying value as per Ind AS 16 is equal to, you must have read this concept in Ind AS 16, is equal to cost minus accumulated depreciation minus accumulated impairment losses minus accumulated impairment losses. This is the definition of carrying value. This is the definition of carrying value. Okay. Minus accumulated impairment losses. Okay. Impairment loss. Clear? What will be the carrying value in this case? Tell me, what will be the carrying value on 30th June 2020? Please compute. What was the cost? What was the cost? Cost is 20 lakhs. Okay. The cost is 20 lakhs. What is the depreciation for 1920? Dep for 1920. It is 2 lakhs. Dep for 1920 is 2 lakhs. Right. Dep for 3 months, which is June 20 till June 20. How much? If for 1 year it is 2 lakh, then for 1 quarter, how much? 50,000, right? What is the carrying value? The carrying value is 17.5 lakh. This is the carrying value as per step 1. Carrying value, right? This is carrying value as per step number 1. Now, what is the step number 2? What is the step number 2? Step 2. What is the step 2? Calculate fair value less cost to sell. Okay, cost to sell on 1st July 2020. Right? What is this? The fair value less cost to sell on 1st July 2020 is given as 16 lakhs. Is given as 16 lakhs. Right? Now, what is my step number 3? What is my step number 3? Step number 3. Recognize NCA HFS at lower of step 1 and step 2. Basically, recognize NCA HFS at lower of what? Lower of carrying value and fair value less cost to sell. Carrying value and fair value less cost to sell. So what is lower? whether 17.5 is lower or 16 is lower. What is lower? So it has to be recognized at, so what is lower? Lower is 16 lakh. So it has to be recognized at 16 lakh. Okay. Now, what are the accounting entries? What will be the accounting entries? So let me show you the accounting entries, the complete accounting entries, right? And let me know if you have any doubt, any problem so far. Friends, first of all, what is the concept? Whenever an asset will be classified as a non-current asset held for sale, right? So first you need to compute the carrying value as per the respective standard. Respective means if it is an intangible asset classified as held for sale, you need to compute the carrying value as per Ind AS 38. If it is PP, you need to compute the carrying value as per PP. And carrying value means cost minus accumulated depreciation minus accumulated impairment losses as well, right? So you need to compute the depreciation, impairment, everything on the date of classification till the date of classification, right? So you need to compute the carrying value. Then you need to compute the fair value less cost to sale. Then you need to recognize NCHFS at lower of carrying value and fair value less cost to sale, right? Clear? I hope it is clear to all of you, right? Till 30th June, we have to compute as per PP, carrying value as per PP. Then on 1st July, we need to recognize it as a NCHFS, right? So I hope it is clear to all of you so far. It is clear. Accounting entries. Now let's discuss the accounting entries, right? So I'll give you the complete accounting entries. Complete accounting entries. And what are the accounting entries? First of all, the first accounting entry is on the purchase of building. Purchase of building. Purchase of building. What is the accounting entry on purchase of building? On 1st July 19 on 1st April 19, which is 1st April 19. What is the accounting entry on 1st April 19? What is the accounting entry? Very simple, na? Building account debit. Building PP account debit to bank account. Building PPE account debit to bank account, right? Debit. This is credit. Amount is 20 lakhs. So this is 20 lakhs. 21, 2, 3, 4, 5. 20 lakhs, right? Clear? This entry is as per Ind AS 16. Ind AS 16. Okay. Now, what is the second entry? Then you need to charge the depreciation. No, on FY 1920, you need to charge depreciation. Second entry. Charging depreciation for FY 1920. Charging depreciation for FY 1920, right? What is the accounting entry? The accounting entry is depreciation PP account debit to bank account. Depreciation PP account debit to bank account, right? Clear? So depreciation PP account debit to bank account. Sorry, not depreciation PP account debit to bank. Depreciation account debit to PPE or accumulated depreciation, right? What is the depreciation for that year? 20 lakh divided by 10, 2 lakh, right? This is the depreciation entry, normal depreciation entry. Again, it is as per Ind AS 16, right? Then you need to charge this depreciation again on building till June 2020. Same entry. You need to charge this depreciation again. Charging depreciation for June 2020. Sorry, June 2020. Right? Again, same entry, depreciation account debit to PP account. Okay. But now the amount is 50,000. That is for 3 months. Right. So this is Ind AS 16. So now your carrying value become 17,50,000. So this is the first set of entries. Now, next entry, fourth entry. Classification to HFS on 1st July 2020. Fourth entry. This is important entry. This is a new entry for you guys. Classification of PPE to NCA HFS as on 1st July 2020. As on 1st July 2020, right? Classification of PPE to NCA HFS on 1st July 2020. What is this accounting entry? Friends, first of all, you need to recognize it at lower of fair value and cost to sell, lower of carrying value and fair value less cost to sell, right? So first of all, you need to recognize NCA HFS account debit, NCA HFS account debit, NCA HFS building account debit. You need to recognize a non-current asset held for sale debit. At what value? At what value you will recognize? At lower of fair value less cost to sell and carrying value. Carrying value is 17.5, fair value is 16 lakh. So you need to recognize at 16 lakh. 16 lakh, okay. NCHFS account debit 16 lakh. 2. You need to credit PP. There is no PP now. To PP building account. To PP building account will be credited. Okay. And what is the value? So building account will be credited by what value is left in building PP account? 20 minus 2 minus 50,000. 17 lakh 50,000, right? 17 lakh 50,000. Sir, credit is 1750, debit is 16 lakh. Where the difference will go? The difference will be impairment loss on classification as HFS, right? So this will go, this impairment loss will go on the classification as HFS, right? Debit. 1750 minus 16 lakh, 1,50,000. So this impairment loss will be debited on classification as HFS. Any doubt so far, friends? Any doubt regarding these accounting entries? Any problem, any challenge, any doubt? Please let me know. Yeah, are you clear so far? So now I am moving into the more complexity of this, right? Are you clear so far? Any challenge so far? Now the question will arise, whether depreciation will be charged. Whether depreciation will be charged post 30th June 2020. Tell me whether depreciation will be charged post 30th June 2020 because it has classified as a non-current asset. It has classified as a current asset. Non-current asset held for sale. So what will be the situation for depreciation? Now, after 30th June 2020, there is no Ind AS 16 will be applicable. No Ind AS 16 will be applicable, right? Depreciation, whether depreciation will be charged or it will not be charged. Tell me, what is the situation? Friends, once the asset classified as non-current asset held for sale, the depreciation or amortization will be stopped immediately. Why? Because the intent of the company is not to get the future economic benefit by using the asset. Rather, the primary intent is to sell the asset, and that is why it has been transferred from non-current to current, right? As I have shown you in the balance sheet of Ultratech Cement. Clear? Is it clear? So once the asset is classified as NCHFS, then depreciation or amortization will be stopped immediately because the intent of the company is not to get the future economic benefit by using the asset. Rather, the primary intent is to sell the asset. Understood? Is it clear? Sir, what will be the measurement requirement if the above building has not been sold till the reporting date? Are you getting me? I am talking about subsequent measurement. I am talking about the subsequent measurement. What is the measurement requirement if the above building has not been sold till 31st March 2021? So we understood on 1st July 2020, the building has been shifted from PPE to NCHFS. Shifted from NCA to CA, non-current to current. We understood the measurement at the time of initial recognition of non-current asset held for sale. We understood that we need to compute the carrying value as per the respective standard. We understood that we need to compute the fair value less cost to sell, and we need to recognize the NCA HFS at the lower of carrying value and fair value less cost to sell. And if there is any loss, that loss will be recognized as an impairment loss in the P&L on classification as HFS. Depreciation and amortization will be stopped immediately. Why? We understood that because the intent is not to use the asset. The intent is to sell the asset because it is available for immediate sale in the present condition. Okay. The intent is to sell the asset. Clear? Now, what about subsequent measurement? I am talking about subsequent measurement. Subsequent measurement. So I am giving you three scenarios just to make this concept well understood by you guys. I am giving you three scenarios. Okay. So first of all, what is the requirement of subsequent measurement? The requirement is subsequently on the reporting date. Subsequently, NCA HFS has to be remeasured, on fair value less cost to sell. Has to be remeasured. So on the reporting date, subsequently, NCHFS has to be remeasured on FVCTS, fair value less cost to sell. But if FV less CTS has increased, has subsequently increased, then impairment, then the increase will be recorded only to the extent of earlier recognized impairment losses. Right. What is meant by earlier recognized impairment losses? Earlier recognized impairment losses under Ind AS 105 and Ind AS 16 or 38 or 40, etc. Right. Sir, what does it mean? So let me give you three scenarios to make this concept understand very well. Right. Case number one, fair value less cost to sell becomes 17 lakh. Fair value less cost to sell is 17 lakh. Now, so we have recorded on 30th June, on 1st July 2020, we have recorded at 16 lakh. Na? My NCHFS is coming at 16 lakh, and I have already recorded a loss of 1,50,000 in my books of accounts, right? So now it becomes 17 lakh. It means I have to debit my NCHFS building account debit to what is to impairment reversal to impairment reversal in P&L. Right. Credit. So how much is the credit? 17 lakh minus 16 lakh. 17 lakh minus 16 lakh. 1 lakh. Right. So 1 lakh impairment will be reversed in the P&L. Income will be recorded, and your NCHFS will be increased by 1 lakh rupees. Right. Case 2. So case 1 is pretty simple. Case 2. FV less CTS is your 18 lakhs. It has been increased by 2 lakhs. Okay, so your FV less CTS is your 18 lakhs. Okay, let's say instead of 17 lakh, it is 18 lakhs. Now what will happen? Of course, NCHFS building account will be debited. Your impairment loss will be credited. So this will be there, right? But the point is, by how much amount? So the question is by how much amount? What is the amount? Right? What will be the amount? Friends, earlier it was 16 lakh. Now it become 18 lakh. So there is an increase of 2 lakh, right? But earlier we have only recorded the impairment loss of 1,50,000, right? And in Ind AS 16, we haven't recorded any impairment losses in this question, right? So in this case, the increase is not 2 lakh rupees. The increase is 1,50,000 rupees to the extent of impairment loss earlier recorded, right? So it means subsequently only reversal of impairment loss is allowed. So over and above, recording of gain is not allowed. Only reversal of impairment loss is allowed, right? So I think it is quite clear to all of you. It is quite clear to all of you now. Case 3, case 1, case 2, case 3. Case 3. Fair value less cost to sell become 15 lakh now, right? So here the increase in FV less CTS recorded only to the extent of earlier impairment loss. Earlier it was 16 lakh at the time of initial recognition of NCHFS. It was 16 lakh, but now the value is reduced to 15 lakh. So once again, you need to recognize impairment loss. Impairment loss on subsequent remeasurement debit to NCHFS building. Right? Be credited. So this will be reduced by 1 lakh rupees. 16 lakh minus 15 lakh. So you need to recognize 1 lakh rupees of impairment loss subsequently, right? I hope with the help of these 3 cases, the concept is clear to all of you. Let me know if you have still any doubt regarding this treatment. I hope this measurement part is clear to all of you guys. Is it clear to all of you? Yeah? Is it clear? Good. So friends, immediately before the initial classification of the asset as per held for sale, the carrying amount of the asset is measured as per applicable Ind AS, which is 16, 38 or 40, which is your step number 1, right? Any impairment loss is recognized in P&L unless the asset had been measured at a revalued amount under Ind AS 16 or Ind AS 38, in which case the impairment is accounted for as a revaluation decrease. For example, if you have opted for a revaluation model prior to classification as HFS, right? And at the time of reclassification as HFS, or at the time of computing the carrying value on the date of classification of HFS, which is step number 1, if there is any impairment loss and you have revaluation surplus also, so that impairment loss has to be adjusted with the revaluation surplus, right? Clear? So now we need to recognize, or we need to measure the NCHFS at lower of carrying value and fair value less cost to sell. We have already discussed this. Okay. Any impairment loss arising upon reclassification as held for sale is recognized in P&L, right? So if there is a difference between the fair value less cost to sell and carrying value, it will go to your P&L. Right? Gains are recognized if your fair value less cost to sell has been increased, right, then gains are recognized, but not in excess of cumulative. What is meant by cumulative impairment losses? Means impairment losses recognized in Ind AS 105 or previously recognized in accordance with Ind AS 36, which is under Ind AS 16, Ind AS 38, Ind AS 40, right? Ind AS 16, 38, 40, etc. Clear? When the sale is expected to occur beyond 1 year, cost to sale must be measured at their present value. Sir, what does this mean? So I'll tell you this. Depreciation or amortization ceases at the moment it is classified as held for sale. And depreciation or amortization has to be ceases. Depreciation amortization has to be stopped at the time it is classified as held for sale. As I told you, why? Because the intent is not to use the asset. The intent is to sell the asset. And that is why it is classified as a current asset. Right? Sir, what does it mean when the sale is expected to occur beyond 1 year? Right? What does it mean? Friends, this means that when the sale is expected to be complete beyond 1 year, then the cost to sell needs to be discounted at present value, right? Then the cost to sell needs to be discounted at present value. But what does it mean? So just a minute. Yeah, I hope my Excel file is visible. When the sale is expected to be completed beyond 1 year, then cost to sell needs to be discounted at present value. What is the meaning of this? For example, the date of classification as HFS. The date of classification as HFS is, let's say, 1st July 2020. Okay, 1st July 2020. Clear? Fair value on the date of HFS, right? Fair value less cost to sell. Fair value on the is, for example, 10 lakh rupees. It is 10 lakh rupees. Fair value is 10 lakh rupees, right? Oh. Just a minute. Yeah, fair value is 10 lakh rupees. Cost to sell is 1 lakh rupees. So when this cost to sell will incur, the cost to sell will incur at the time of sale, right? At the time of sale. So cost to sell is 1 lakh rupees, right? Cost to sell is 1 lakh rupees, right? So friends, discount rate, for example, the incremental borrowing rate or discount rate or interest rate for this company is 10%, right? And it is expected that the sale will happen after 1 year, beyond 1 year. So in this case, for computing the fair value less cost to sell, this cost to sell needs to be discounted at present value. So what is my fair value? My fair value is 10 lakh. My fair value is 10 lakh. What is my cost to sell? My cost to sell is 1 lakh divide by 1 plus 10%. Right. So it will be 90,910 rupees, 90,909 rupees, right? So my fair value less cost to sell will be, my FV less CTS will be 10 lakh minus 90,909. It is 9,09,091 rupees. Okay. If the sale is not expected to go beyond 1 year, in that case, you are not required to compute this cost to sell at a present value. In that case, the fair value less cost to sell will be 9 lakh rupees, not 9,09,091 rupees. So if the sale is expected to complete beyond 1 year, because on the initial recognition of NCA HFS, you are computing fair value less cost to sell and you are comparing with the carrying value, and then you are recognizing the lower value, right? As a NCA HFS, right? Is it clear? So this is how we are doing the calculation of cost to sell for deducting this cost to sell from fair value and to computing this fair value less cost to sell on the date of classification of HFS. I hope it is clear to all of you guys now. Clear? Yes, Sailendra, this notes will be given and I am preparing these notes for you guys only, right? I hope it is clear to all of you guys, all of you now. Now let's discuss an important case study, right? So case study on measurement prior to classification is held for sale. Entity ABC owns an item of property and it was stated at following amounts in the last financial statement. 31st March 2001, cost 12 lakh, depreciation 6 lakh, net book value is 6 lakh. The asset is depreciated at annual rate of 10%, that is 1,20,000 per annum, right? So this is the carrying value in the balance sheet of 31st March 2001. Entity ABC closes its books on 31st March each year. During July, entity ABC decide to sell the asset and on 1st August, it meet the condition to be classified as held for sale. Analyze. Friends, what is your step number 1? What is your step number 1? Your step number 1 is compute the carrying value as per Ind AS 16. So in this case, the 31st March 2001, it is 6 lakh rupees, right? Per annum depreciation is 1,20,000 rupees. And subsequently, on 1st August, it is meeting the held for sale criteria. It means for how much months depreciation you need to compute? April, May, June, July, 4 months depreciation. If 1,20,000 is per year depreciation, what is your 4-month depreciation? Your 4-month depreciation would be 40,000. So 6 lakh minus 40,000, 5 lakh 60,000 will be your carrying value, right? Clear? So as at 31st July, step number 1, as at 31st July, entity ABC should ensure that the asset is measured in accordance with Ind AS 16. It should be depreciated by further 40,000. 120 multiplied by 4 divided by 12 and should be carried at 5,60,000 before it is measured in accordance with Ind AS 105, right? And from the date the asset is classified as held for sale, no further depreciation will be charged. Clear? Is it clear? Good. Now let's do the quick revision. What is meant by non-current asset held for sale? Non-current asset held for sale are those assets where the primary intent is to recover the future economic benefit through sale, not through a continuing use, right? What are the criteria for classifying the asset or disposal group as held for sale? The criteria is ISPC plus HP. The criteria is it should be available for immediate sale in the present condition. And for looking at the availability of immediate sale in the present condition, you need to look at the intent and ability, right? And the time period is not a distant future. The time period used to be a normal time period, which is required, which is a usual and customary time for sale of such kind of transaction. Sale will be considered as highly probable and 5 conditions will be satisfied. First, management must be committed to plan to sell the asset. Second, active program to locate a buyer. So buyer searching has been started, quoted at a reasonable price. Sale is likely to complete within 1 year, right? Fifth, it is unlikely that the plan will change. It is unlikely that the plan of sale will change, right? Clear? It may go beyond 1 year when first condition, binding agreement has been entered. Second condition, the delay is due to the third party, buyer, or due to the conditions or situation which is beyond the entity's control, right? Whether asset temporarily taken out of use is termed as abandoned or classified as CFH, it has to be termed out as abandoned asset, right? What are the measurement provision for asset which are classified as held for sale? The asset which are classified as held for sale has to be recognized at lower of carrying value and fair value less cost to sell. The carrying value has to be computed on the date of classification as HFS as per the respective standard, right? Fair value less cost to sell has to be computed on the date of HFS as per Ind AS 105. Whatever is the lower at that value, this NCHFS is going to be recognized in the balance sheet as a separate line item under the kitty of current assets, right? Whatever is the difference, it will go to the P&L between the carrying value and fair value less cost to sell, right? Sir, if fair value less cost to sell is higher than the carrying value, then friends, the word is lower. If it is higher, of course, your carrying value will become lower. Then it will be at carrying value. And in that case, there will be no impairment on account of change in classification from Ind AS 16 to Ind AS 105, right? Once the asset has been classified as held for sale, subsequent depreciation and amortization will be stopped, right? If the asset will not be sold out actually till the reporting date, you need to compute fair value less cost to sell again, right? And if the fair value less cost to sell is again declined, you need to book the impairment losses. But if it is increased, you need to record the increase only to the extent of previous impairment losses. Previous means Ind AS 16, 38, 40 as well as Ind AS 105. What is Ind AS 105 loss? Which you have recognized on at the time of the first accounting entry when you are shifting the classification from Ind AS 16 to Ind AS 105, right? So I have also completed the revision for you guys, right? Clear? Hope it is clear to all of you. Very good. Thank you, Manini. Thank you so much. Koshiki is asking on what date the cost to sell to be discounted? Of course, Koshiki, on the first date, on the date of classification as HFS, when you are computing fair value less cost to sell, right? Yeah. So friends, now let's discuss this case study. It is there in your study material as well. And this is a comprehensive case study, right? A property is purchased for rupees 5 lakh on 1st April 2018. A property is purchased for rupees 5 lakh on 1st April 2018, right? The useful life of the property is 20 years, zero residual value. The property is measured subsequently at depreciated historical cost, straight line method, cost model, right? So if 5 lakh rupee is the cost, what is the per annum depreciation? What is the per annum depreciation? 5 lakh divided by 20, 25,000 is the per annum depreciation, right? 25,000 is the per annum depreciation. Am I right? Friends, what is the per annum depreciation? I'm not getting the answer. Yes, it is 25,000. Very good. Okay. On 30th September 2020, it means 1st April 2018 property was purchased, 31st March 19 1 year, 31st March 20 second year, and 30th September 20 means after 6 months. So after 2 years and 6 months, it is decided that the property is to be classified as HFS. Why? Because the classification criteria are meeting. What are the classification criteria? ISPC plus HP was meeting, and hence it was decided to classify this property as a held for sale, right? And this classification means it is moving from Ind AS 16 to Ind AS 105. It is moving from non-current to current. An impairment assessment on 30th September determines that the recoverable value based on value in use to be rupees 4 lakh. Determines that the recoverable value based on value in use to be rupees 4 lakh, right? Friends, an impairment assessment on 30th September 2020 determines that the recoverable value based on the value in use is to be rupees 4 lakh, right? Now tell me, just forget about Ind AS 105. Tell me, even under Ind AS 16, whether you guys were looking at impairment loss or not. Whether you guys were looking at impairment loss or not. Impairment loss is a fundamental principle. Impairment loss is a fundamental principle. What is the concept of impairment loss? The concept is any item in your balance sheet should not be stated at more than the recoverable value. That is the concept, right? And that is why while computing carrying value, the formula is cost minus accumulated depreciation minus accumulated impairment loss. This is the formula, right? So friends, in this case, on 30th September 2020, you need to compute the carrying value H per Ind AS 16. Carrying value H per Ind AS 16. First of all, the cost as on 1st April 18 is 5 lakh. The cost as on 1st April 18 is 5 lakh, right? It is 5 lakh rupees. The cost is 5 lakh. The depreciation for 2018-19 is 25,000. The depreciation for 19-20 is 25,000. So it is not 18, it is not 19, it is 18, 19, 19, 20. And depreciation 6 months for 2021 is 12,500. So what is, this is the cost. This is my cost. This is my accumulated depreciation. So what is the value on 30th September prior to impairment assessment? It is 437,500. But what is the formula for carrying value? The formula for carrying value is equal to cost minus accumulated depreciation minus accumulated impairment losses. If the recoverable value is 4 lakh rupees, what does it mean? It means there is an impairment loss of 37,500. So this 4 lakh is the carrying value as per step number 1. This 4 lakh is the carrying value, not as per Ind AS 105. This is carrying value as per Ind AS 16. Are you guys with me? Are you guys with me? Yeah? Are you with me? So the carrying value, which is cost less accumulated depreciation minus, why the word is accumulated impairment losses? Because even under Ind AS 16, you need to look at the impairment assessment as well, right? And if you find that the recoverable value is declining, you have to book the impairment loss as well. Doesn't matter whether you are opting for revaluation model or not. Even though if you have opted for the cost model, you have to recognize the impairment loss, right? Is it clear? If you have opted for cost model, the increase is not going to be recognized, but the decrease is always going to be recognized by the conservative principle, right? So step number 1 is clear. Now step number 2, the fair value less cost to sell on 30th September 2020 is 3,90,000. So the value as per step number 1 is 4 lakh. The value as per step number 2 is 390. So what is lower, 390 or 4 lakh? 390 is lower. So carrying value is 4 lakh. Fair value less cost to sell is 390. What is the accounting entry? NCA HFS account debit 3,90,000 to PPE 4 lakh, right? Impairment loss on classification as HFS debit 10,000, right? This will be your accounting entry. So in this case, sir, what happens if, so of course we have recognized NCHFS at 390. Subsequently, on the reporting date on 31st March 2021, for example, this value will become 4,50,000. Then what will happen? So we have recognized at 390, it will become 4,50,000. So there is an increase of 60,000. So can we recognize that 60,000? Answer is no. You can recognize the increase only to the extent of previous impairment losses. Previous means this 10,000 plus 37,500 under Ind AS 16 as well. So 37,500 plus 10,000 in your lifetime, you can recognize only the impairment reversal to the extent of 47,500, right? Is it clear? Is it clear, friends? Is it clear? I hope it is clear to all of you. Yeah. Now let's discuss the concept of disposal group, the measurement requirement for disposal group, which is very simple, right? Which is very simple, I would say. It is very simple. Don't worry about that, right? So concept of disposal group. What is a disposal group? So disposal group means group of assets, which may include current asset as well, which may include liabilities as well, Okay, clear? Now we are talking about the disposal group. Okay. Any doubt so far? So before moving into the disposal group, if you guys have any doubt, I want to discuss that. Otherwise, I'll move on. Let me know if you guys have any doubt. Any doubt, students? So Manini has replied, Aniket has replied, Rohan has replied, Radhika has replied, Rahul has replied. Okay, so let's discuss the concept of disposal group. Very good. Koshiki is asking, sir, why don't we discount fair value? So Koshiki, please try to understand. The fair value is as on date. Are you getting me? The fair value is as on date. You are computing market value on the date of classification as HFS. But if I'm talking about cost to sell, right? When cost to sell will be incurred? Cost to sell will be incurred at the time of actual sale. At the time of actual sale, right? If sale is expected to happen after 2 years, then 2 year discounting done. Yes, Koshiki, then 2 year discounting is required to be done. Yeah. I hope you have understood why fair value is not to be discounted, because fair value is today's value. Date of classification as HFS value, but cost to sell will be incurred at the time of sale, right? You are entering into agreement at today's value. When you are quoting a price, the third condition was there, na, that you have to quote a reasonable price in comparison to market value. So you are looking at today's price, right? Good. Thank you. Yes. Now let's discuss about the disposal group. We will discuss with the help of this example. Following details are given for entity A: goodwill, property, plant and equipment, inventory, financial asset, financial liabilities, right? And there is a carrying value on 31st December, the carrying value of this goodwill, PP, inventory. This is a current asset. And these are the financial asset and financial liabilities also. So in this question, in disposal group, current asset is there, then your financial asset is there, and even liability is also there, right? Liability is also there. So the total is 67 million is the carrying value. Under Ind AS, property, plant and equipment would be stated at 26 million and inventory is stated at 18 million. Right. So the carrying value, the step one is given. The step number one is given that you need to compute the carrying value as per the respective standard, right? Prior to reclassification. So this is given at 26 and this is given at 18. The fair value less cost to sell of the disposal group is 47 million. And step number two, the fair value less cost to sell of this entire disposal group is given at 47 million. Assume that the disposal group qualifies as held for sale. You are required to show how the disposal group would be accounted for in the financial statement for the year ended 31st December 2020. Before showing this disposal group, let me show the annual report first. Let me show you the annual report first, right? Friends, please let me know if you are able to look at the Hindalco Industries annual report. Please let me know if you are able to see the Hindalco financial statement. If you're able to see the Hindalco Industries financial statement. Are you able to see the Hindalco Industries annual report? Please confirm. Yeah. Let me show you the balance sheet first. Non-current asset, right? There are a lot of non-current assets are there. Then current asset is there, and after current assets, there is a non-current asset or disposal group classified as held for sale is there. Non-current asset or disposal group classified as held for sale is there. And let me show you the liability part also, right? Let me show you the liabilities part also. This is the current liabilities. So on the left side, non-current liabilities are also there. So this is a complete balance sheet. Don't worry about this. This is equity. This is non-current liability. Then on the next page, there is a current liability, right? Current liabilities. And when you look at the current liabilities, there is a separate line item. Liability associated with disposal group classified as held for sale. So my intent is just to show you that in disposal group held for sale, there could be liabilities also, right? And these liabilities has to shown separately. These liabilities has to shown separately. Okay. And before this, let me again show you the accounting policy, right, of disposal group. Sorry, accounting policy of non-current asset held for sale and disposal group, right? Because now we have enough understanding of measurement requirement also. So we will talk about non-current asset or disposal group held for sale accounting policy practically, right? Non-current asset and disposal group are classified as held for sale if their carrying amount will be recovered principally through a sale transaction rather than through continuing use. Sir, this you have already told us. This condition is regarded as met only when the asset is available for immediate sale in the present condition, subject only to the terms that are usual and customary for sale of such asset or disposal group, and sale is highly probable. Sir, this is there in your slide as well. Okay. Management must be committed to the sale, which should be qualified for recognition as a complete sale within 1 year from the date of classification. Sir, you have told us this part. Okay. Non-current asset and disposal group classified as held for sale are measured at lower of their carrying value and fair value less cost to sell, except for those assets that are specifically exempt under relevant Ind AS. What does it mean? It means that, you remember I have told you the measurement exception. You remember that, right? So on those assets, for example, deferred tax has to be computed as per Ind AS 12. Your plan assets has to be computed as per Ind AS 19, right? So except those assets, the measurement condition should be applicable as per Ind AS 105. Once the assets are classified as held for sale, those are not subject to depreciation till disposal, right? I have told you that depreciation is not applicable. Yes. An impairment loss is recognized for any initial or subsequent write down of the asset. An impairment loss is recognized for any initial or subsequent write down of the asset or disposal group to fair value less cost to sale. Have I told you that when you will classify from PPE to Ind AS 105, you have to recognize at lower of carrying value and fair value less cost to sale, and whatever decline is there, it has to be recognized as impairment loss. And subsequently, again, if there is a further decline from initial recognition to reporting date, it will again recognize as impairment loss. And again, it is written that a gain is recognized for any subsequent increase in fair value less cost to sell of an asset or disposal group, but not in excess of any cumulative impairment loss previously recognized. Have I told you this concept that the gain has to be recognized, but not in excess of previous impairment losses, right? Clear? A gain or loss not previously recognized by the date of the sale of the non-current asset is recognized at the date of derecognition, and the actual gain or loss will be recognized at the time of derecognition, means actual sale, right? Clear? Non-current asset classified as held for sale and the asset of a disposal group classified as held for sale are presented separately from other asset in the balance sheet. I have shown you that the non-current asset held for sale, disposal group, liabilities relating to disposal group has to be shown as a separate line item under current asset category in the balance sheet. Friends, do you find the accounting policy of this Hindalco Industries Limited? Do you find that you are already well versed with this accounting policy? Whatever concept we have read, so these concepts are copy pasted in this accounting policy. Can you say this? What is your view? What is your view? Yeah, fantastic, fantastic. Yeah, good. So let's come to the Excel file now to solve this disposal group held for sale case study, right? Case study number 2 from my PPT, right? Wonderful, wonderful. Yeah. So friends, this information is given, right? First of all, step number 1. What is the step number 1? Tell me, what is step 1? What is step 1? Carrying value on the date of HFS. Compute carrying value on the date of HFS. So step number 1. carrying value, on the date of HFS is given. So there is no information on goodwill. We will consider goodwill as 16 only, right? We will consider this goodwill as 16 million only. But for PP, the information is given that PP carrying value is 26 million. Carrying value of inventory is 18 million. We'll consider the financial asset at 17 only. We'll consider the liabilities at 15 only. So the total comes out at 63. The total comes out at 63. So compute carrying value on the date of classification HFS, it is 63 million. Step number 2. What is the step number 2? Compute fair value less cost to sale on the date of HFS. Which is 47 million given in the question. Now, what is the impairment loss? You need to recognize at lower of 63 and 47. So what is the impairment loss? What is the impairment loss? Of course, 63 minus 47, right? Step number 2. What is my step number 2? My step number 2 is FV less CTS. And the total of FV less CTS is given. The total is given, right? So the individual values are not given. The total is given, right? Now the question arises. If you have to recognize at lower of carrying value and fair value less cost to sell, there will be impairment loss. There will be an impairment loss. Now the question arises that how this impairment loss of a group has to be allocated. How this impairment loss has to be allocated in the group. This is the question, right? This is the question. Okay, right? Friends, the total is 16 million. In this case, we have to apply the principles of Ind AS 36, right? For allocation of impairment loss, apply the principles, apply the provisions of Ind AS 36. And what Ind AS 36 says? Ind AS 36 says that if there is an impairment loss on the cash generating unit, which is a disposal group, which is a group of assets, then you need to strike goodwill as a first thing, right? So you need to first impair the goodwill. So in this case, we need to impair the goodwill first, right? We need to impair the goodwill first. So 16 million is itself a goodwill. Goodwill will become zero. Goodwill will become zero, and the remaining asset will come as a same value, right? So this will become your 47. Okay, and this will be your impairment loss. So goodwill will become zero, and the remaining asset will come as it is. And in the notes to accounts, the value of the remaining asset has to be shown in the notes to accounts as a breakup of disposal group held for sale. Sir, what happens if this will not be 16 million? This will be 20 million. Ind AS 36 says that the remaining, after hitting or striking of the goodwill, if there is a remaining impairment loss, it has to be allocated pro rata on the revised carrying value of the asset, right? It has to be allocated pro rata. Understood? It has to be allocated pro rata. But whether we need to allocate to financial asset also, answer is no. Why? Because the measurement exception is there for financial asset, right? Clear? So we need to allocate the impairment losses first on the goodwill, then on the remaining asset on the pro rata basis. Is it clear or not clear? Tell me. Friends, is it clear or not clear? So step 3 is my recognized at lower, and lower is 16 million of impairment loss. So what will be the accounting entry? What will be the accounting entry? What is the accounting entry? Disposal group. Disposal group held for sale asset debit, right? The remaining accounting and disposal group held for sale debit by how much amount? 26 plus 18 plus 17, 61. 2. Disposal group liability, right? To disposal group liability by how much amount? 14 million. Okay. To disposal group liability. Two. Credit will be your credit will be what? What will be credited? Your credit will be all the assets to goodwill, to PPE, to inventory, to financial asset, right? To inventory, to financial asset, and this financial liability will also be debited. Why? Because now it will become a part of the disposal group. Financial liability will be debited, right? So let me show like this. This is debit, this is credit. Assets will individual asset will be credited and liability will be debited, and it will form part of your disposal group, right? So liability will be debited by 14, and this will go to the disposal group liability. Financial liability debit to disposal group liability. Now these assets will be credited. 16. Okay, these will be credited. And this will go to the 61. 61 has gone to the between 77. 61 disposal group held for sale has been debited. It means the difference is impairment loss debit. This is your 16 million. And if you will see, your total must be tallied. So this is an accounting entry. This is accounting entry, right? So we have reversed all the assets and liability. Why? Because it has formed part of your disposal group. Clear? But the breakup of this disposal group held for sale has to be shown. And what is the breakup? So this has to be shown in the notes to account. PP, inventory, financial asset, these three asset, and this one liability. Clear? Is it clear? Koshiki, because financial asset is out of the scope of Ind AS 105 as far as measurement is concerned. Financial asset itself is at fair value, right? I hope it is clear to all of you, right? So friends, we have completed the disposal group case study also, right? And how this disposal group has to be shown under current asset, non-current asset classified as held for sale, or oblique disposal group classified as held for sale. 61 million. Liability is directly associated with non-current asset, not non-current asset, with disposal group classified as held for sale. 41 million, right? So this is how we will present this. So friends, since morning we have touched so many concepts. We have understood the measurement requirement of non-current asset held for sale, individual asset, as well as disposal group held for sale. So now the time has come to conclude the session. Let me know if you have any doubt, any query, or you want me to explain the concept again, whatever I have discussed in the last 3 hours. So if you want me to explain it again, I'll explain it again. Okay. Otherwise, I'll be happy to conclude the session for the day. And day after tomorrow on Tuesday, we will complete this. Ind AS 105, right? Clear? So let me see the query box. If there is any query is there. Yeah. So Rahul is asking, sir, in case of a disposal group classified as held for sale, do we need to disclose in the notes to accounts that what is the impairment loss on the disposal group? Yes, Rahul, you need to disclose that in the notes to accounts, and you need to provide, because in the balance sheet, you are giving just one line item as a disposal group classified as held for sale. But you need to, provide the breakup of the disposal group classified as held for sale in the notes to accounts. Okay. Yeah. So Manini is saying, sir, please explain the last entry. Koshiki is saying, take case 2 with impairment loss 18 for journal entry. Okay. Yeah. So first of all, let's discuss about the what you will do, see, in this case, there are two things. One is disposal group held for sale asset and disposal group liability, right? There are two items, disposal group held for sale asset and disposal group held for sale liability. Disposal group HFS asset and HFS liability. Am I right? Disposal group held for sale asset and held for sale liability. First of all, let's understand this thing. There are individual asset and individual liability. You need to reverse that individual asset and individual liability, right? Why? Because it has become part of your disposal group held for sale. Of course, under disposal group held for sale, they have their own value. They have their own value, right? For example, earlier goodwill was there. So remaining assets are at same value. Remaining assets are same value which we have credited. These are at same value, but earlier the goodwill was there, and that goodwill is not there in the current disposal group. So this has been become part of your impairment loss. Same accounting entry which we were making earlier, right? So if it was an individual asset held for sale, what accounting entry you are passing? Tell me. You are passing NCA HFS debit, right? To PP. That accounting entry you are passing, and the difference goes to impairment loss. Impairment loss, right? What accounting entry we have passed now in the disposal group? Disposal group held for sale debit, right? To assets, to all assets, right? Same accounting entry I have passed, impairment loss, right? Same accounting entry I have passed here also. Here one more element is there. Here a disposal group liability is also there. If disposal group held for asset will be debited, held for sale asset will be debited, of course disposal group HFS liability will be credited now. This is a liability, so this will be credited, right? And your liability will be debited. Why? Like your normal asset have been credited and disposal group asset have been debited. Likewise, your disposal group liability will be credited and normal liability will be debited, right? Normal liability will be debited. If there is any difference between this will again go to the impairment, right? But there will not be any difference between the liabilities. Okay, so same accounting entry I have passed here. Understood? What we were doing earlier, NCA we are debiting and the normal asset we are crediting. So likewise, group I have debited and normal asset I have credited. So that's what I have done the accounting entry. And of course, these values are which values? Revise step number one. Step number one value. Step number one. This is this value. Step number one. Compute carrying value as per the respective standard. Then compute fair value less cost to sell. The difference will go to impairment loss if it is lower. Right? Is it clear? Let's say instead of 16, it will become 18. It will become 18. Let's say instead of 16, the loss is 18, for example. Then what will happen? In this case, the 16 loss will go to your, 16 loss will go to the goodwill, right? And the remaining loss of 2 million, the remaining loss of 2 million will be allocated to which assets? Will be allocated to PP, will be allocated to PP, not inventory, not financial asset. Why? Because standard says that if you will read Ind AS 36, it says that if an asset is itself at the fair value, for example, inventory has to be stated at cost or NRV, whichever is lower, right? So it means it is already at fair value. Financial asset, if you go to Ind AS 109, it says that financial asset has to be measured at fair value. So it means if something which is already at fair value, you cannot reduce the value by more amount due to the allocation of impairment losses, right? So in this case, this 2 million will be debited to the property, plant and equipment, right? This 2 million will be debited to PPE. This 2 million loss will be allocated to PPE. So this will be the situation, right? Clear? Is it clear, Kaushiki? Kaushiki, is it clear? Thank you so much, guys. Thank you so much. So it's 10:01 now. So I hope you have enjoyed today's session, and we will be completing this Ind AS 105 in the next session. And I would request each one of you that please go through with the institute study material and revise all these concepts, right? Thank you so much. Bye bye. Take care.